All right, and then we've got the equity section. This represents what assets are attributable to the owner as opposed to third-party liabilities, whether that owner be a sole proprietorship, a partnership, multiple owners, or a corporation where the owners are represented as shareholders. So if you think about equity just in total, it makes sense no matter what the entity is. I don't care. I'm just going to say the owner or owners, right? Meaning all owners as a collective, if there's more than one, is going to be the net value of the business, right? And that net value of the business we can think of as assets minus liabilities is going to equal equity, the net value of the business. And you can also think of it as how you generated the net value of the business. Where did it come from? When you start the business, you finance the business typically. So so the finance comes from a loan or from you, the owner. So if the owner put money into the business, then that's going to be contributed into equity. Where does equity come from after that? Well, hopefully you generate revenue. And if you generate revenue, then you can put the revenue back into the business instead of distributing it, in which case you would have accumulated revenue, accumulated earnings over the time of the business. So those are the ways that equity could go up. So in other words, how could equity go up? Well, the owner can put money in, which typically happens at the start of the business. And if it's a sole proprietorship, you, the owner, put money in. If it's a partnership, the partners put money into the business, which would impact their individual capital accounts, which we would have to track separately. If it's a corporation, the corporation issues stock, which means people are paying for the value of the business. And the stock portion then represents, in essence, the owner investment in the business. The other way that equity goes up is retained earnings, which means that we generate revenue, and this is how the balance sheet is linked to the income statement. The income statement represents performance. We generate revenue over a time frame, which then is going to flow into the balance sheet as earnings. So that's going to be the retained earnings, the earnings that have gone up, but we have not distributed them to the owner. And then how does equity go down? Equity is going to go down typically by the distribution of the retained earnings or the equity to the owner. If it was a sole proprietorship, that would be in the form of draws. We would just take money out of the business typically. Partnership also draws, meaning different partners would take money out of the business, but we would have to track that per partner so that we can track each partner's equity account in a similar way as we would track, say, accounts payable by vendor. And if it was a corporation, we call them dividends. Now, dividends, you can't just draw out, right? Because that means the dividends have to be agreed upon so that all shares get an equal disbursement of the dividends, because that's how we make all the shares the same, which is the thing that made the corporation construction easier by giving shares that are all equivalent. So the trade-off of giving shares that are all equivalent is that we have to make the distributions on a per share basis, and that's going to be more of a bureaucratic kind of process so that we can keep everything basically the same is the general idea with that. Okay, so that leads into how is the balance sheet tied into the income statement, otherwise known as the profit and loss. We'll talk about the profit and loss more later, but notice that the balance sheet is as of a point in time, basically just has one date up top, although we put 2 periods here. Whereas the income statement is a performance statement. It will typically say on the heading, it's going to be from one period to another period. For the period ended is a traditional way that it's going to be stated. And that means that it's going to have a starting and an end. So this is the performance statement. This is how well we did over a certain time frame. And therefore, you can think of this statement as kind of like part of the balance sheet. In other words, the bottom line of the income statement, the 180131, is going to roll into the balance sheet over here. So QuickBooks actually puts the net income in here so you can see that. That's useful. Most online softwares do that, but it also becomes a problem if you have like a partnership and you need to allocate the income to the partnership accounts in accordance with the partnership agreement, because now you have this income line item that's down there that looks kind of funny when you do that. But it's supposed to give you an idea of that relationship. And you can see that that net income, when I move into 2025, then flows in to the retained earnings, the earnings that have been accumulated that have not been distributed out. And then we have net income for the current period, 2025 down below, which is currently a loss at this time. So that means that QuickBooks is doing what we call the closing process automatically, meaning if you did this by hand, what you would do is you would create, your income statement, and then you would have to close out the income statement to the balance sheet so that you can then start the new period going forward. But QuickBooks is doing this as we go. But if you're doing it manually, you could close things out on a monthly basis if you wanted to, or a quarterly basis. QuickBooks isn't going to do that. QuickBooks is basically going to close things out on a yearly basis, typically. So that means that, like, you might think, like, if I ran the report for like a month of 01/01/24 to 01/31/24, that it would, or let's say we go, what are we on to? It doesn't have anything for that month. Let's go from 10/01/24 to 10/31/24 and run that. And so now we have net income at 204. Let's do the income statement over here from 10/01/24 to 10/31/24. Run that, and the net income is 112.92. If I go back over here, you would think that that would be the amount in the equity section. I'm in the wrong one. Run it again, but it's not. It's 204.17 because it's giving us the net income on a year-to-date basis. So in other words, if I go back on over here, so this is the net income for that month. If I was to go from, I believe, 01/01/24 and run it, let's check that out. So now we're at the 204.17. And that should be over, is that the right one? That's the wrong one, 204.17. So that's just something. So it's great that QuickBooks will do the closing process for us. But when you start to think, I should do the closing process for a month, I want to close it out on a quarterly basis or something like that, it's not going to work exactly that way on the balance sheet because it defaults to closing everything out on basically a yearly basis. So just kind of keep that in mind. That'll kind of mess your thinking up sometimes when you start to think about the closing process, closing out a month versus a quarter versus a year. All right, so that's the general idea on the balance sheet.